World where banks collapse overnight, fortunes vanish, and the people who trusted the system are left with nothing. Imagine entire communities paralyzed by fear, families losing life savings, merchants unable to pay debts, and governments scrambling to respond. What if I told you that centuries ago, long before Wall Street, long before the 2008 crisis, a philosopher observed the patterns of money, credit, and human greed, and warned that this exact scenario could unfold if humans ignored the moral dimension of finance? This thinker lived in a time when coins were gold, paper money was scarce, and lending was personal, often reliant on trust, reputation, and handshakes. Yet his observations sound eerily modern. He saw the fragility of systems built on faith rather than substance, the dangers of lending more than you hold, and the human behaviors that amplify risk. He warned that debt is like a fire. It can warm and sustain, or it can spread uncontrollably and destroy everything in its path. To understand his warning, imagine the banking system as a massive tree. The roots are the deposits people place in banks, the trunk is the bank itself, and the branches are the loans extended to businesses, farmers, and citizens. When the roots are strong, the trunk stable, and the branches healthy, the tree grows steadily. But if the roots dry up, if the trunk weakens, or if the branches overreach, the entire tree is at risk of collapse. This metaphor, centuries old, mirrors modern fractional banking. Banks lend more than they hold, counting on the assumption that depositors will not all demand their money at the same time. He described greed as a virus, one that spreads silently, relentlessly, inflating bubbles in markets and asset prices until everything seems solid, but in reality, hangs by a thread. He observed that humans, dazzled by the illusion of wealth and security, often ignore early warning signs, trusting the numbers more than the reality, and trusting institutions more than reason. In his writings, he detailed how even small cracks like a minor default or a delayed payment can escalate into widespread panic, triggering a chain reaction that topples entire economies. History has proven him right time and again. From the collapse of medieval banking houses in Florence to the Dutch tulip mania of the 17th century, from the South Sea bubble in England to the more recent 2008 financial crisis, the patterns repeat. Small miscalculations or overextended lending create instability. Human emotion, fear, greed, and overconfidence amplifies the effect. And each time, ordinary citizens bear the heaviest burden, while those who create and manipulate the system often escape unscathed. His insight was not only technical but moral. He argued that money is never neutral, it reflects human behavior and ethics. When morality is ignored, systems fail, because financial structures are ultimately a reflection of human trust, honesty, and restraint. He suggested that ignoring ethics in money matters is like building a city on sand. It may appear strong and impressive, but it is vulnerable to collapse at the first storm. The philosopher also understood the psychology of trust. People rarely panic for no reason, they panic when confidence erodes. Trust is the invisible glue holding the banking system together. Once that glue fails, numbers no longer matter, policies are ineffective, and even governments struggle to restore order. He emphasized that financial collapses are not only about numbers, they are about relationships, human behavior, and shared expectations. Ignore this, and history repeats itself. Let us fast forward to modern times. The global banking system is far more complex than in his era, yet the underlying vulnerabilities remain. Fractional reserve banking, shadow banking, derivatives, and complex financial instruments may be new, but they are just modern branches of the same fragile tree. The 2008 financial crisis was a stark example. Subprime mortgages, poorly understood financial products, and over-leveraged banks created conditions for collapse. When Lehman Brothers fell, the world experienced a shock similar in spirit to the crises he described centuries ago. Governments rushed to bail out failing institutions, pouring trillions into stabilizing economies, yet the human toll was immense. Millions of families lost homes, jobs, and savings. Entire communities felt the ripple effects of systemic failure, and the philosopher's warnings about human behavior, morality, and the limits of trust proved prophetic. The problem was never just technical, it was ethical, human, and psychological. We had replicated the same vulnerabilities he observed centuries before, despite centuries of history to learn from. He also warned of moral hazard, the idea that protecting institutions from the consequences of their actions encourages reckless behavior. If a bank knows it will be bailed out, it takes greater risks, magnifying systemic fragility. This dynamic has played out repeatedly, from medieval defaults to modern financial crises. His work reminds us that without accountability and ethical oversight, financial systems are inherently prone to collapse. Beyond banking, his ideas resonate with broader economic patterns. Inequality, debt cycles, speculative bubbles, and corporate overreach are recurring themes in human history. The philosopher suggested that money is not just a tool, it is a mirror reflecting society's values. When society prioritizes profit over ethics, the system becomes unstable. When greed outweighs caution, when trust is exploited, collapse becomes inevitable. He understood that crises often start small. A minor loan default, a single business failure, or a slight erosion of trust can cascade. Each node in the financial system is interconnected. Panic spreads faster than money, magnifying the effects of seemingly small missteps. This observation is not only prescient, but chillingly relevant. In our interconnected global economy, the speed of contagion is faster than ever. What he observed centuries ago remains true: complexity magnifies human error. Yet, amidst the warnings, there is a lesson of hope. Understanding patterns, studying human behavior, and recognizing ethical responsibilities can reduce the likelihood of catastrophic collapse. Knowledge, caution, and moral integrity are as important as capital and credit. He urged his readers to remember that money, while powerful, is a reflection of human choices and priorities. Ignoring this truth invites history to repeat itself. In conclusion, the philosopher's work teaches us that financial systems are not purely technical constructs, they are living networks sustained by human behavior, trust, and ethics. Collapses are predictable, not mysterious. History is a teacher, if we choose to listen. The moral dimension of money cannot be ignored, and the recurring crises of the past and present highlight a simple, unsettling truth. The real danger lies not in money itself, but in the people who wield it without foresight, responsibility, or morality. So, the question we must ask ourselves is simple, yet profound. If history could warn us, would we finally listen? Or are we doomed to repeat the same mistakes, trusting institutions and numbers over wisdom and ethical responsibility? Money may change, economies may evolve, but human behavior remains constant. And until we address the moral core of finance, the patterns of boom, greed, and collapse will continue to repeat, just as this philosopher predicted centuries ago. The lesson is clear, the warning timeless, and the choice ours. Will we heed it, or will history write the same story again?